Most traders overcomplicate moving averages and miss out on the incredible profit potential, like this trade here that made me over £18,000. Now, moving averages are one of the oldest and most reliable technical indicators in trading, yet they're often misunderstood or poorly implemented. If you are not using moving averages correctly, you're leaving money on the table and potentially making trading decisions based on noise rather than market trends. After testing dozens of variations across different market conditions, I've distilled it down to the simple, repeatable system that I'm about to share with you today. Before we jump into the exact setup I use, let's get clear on what EMAs are, why traders love them, and how to actually use them properly. EMAs stand for exponential moving average. It's just a line on your chart that shows the average price over a set number of candles that you get to decide. But unlike a simple moving average, it gives more weight to recent price action, which makes it more responsive to trend shifts. We use EMAs because they help us filter out noise, stay aligned with real trend, and time entries with precision and confidence. Now in this video, we are going to be focusing on two EMAs. Fast time EMA will be 20 and the slow EMA will be 50. 20 will be a blue EMA and 50 will be a red EMA. All right, let's break this down. Let's head over to the chart and let's add the EMAs. So as you can see, Smart Charts is my preferred trading platform today. So as you can see, I'm on a 30-minute time frame, and that the blue EMA is 20 and the red EMA is 50. Okay, so to really understand how to use moving averages for reversals, there are three simple things I need you to grasp. First, it's the crossover. So what's a crossover? It's when the 20 crosses above the 50, right? It's when the 20 has crossed above the 50. So if 20 crosses above the 50, we are going to be focusing on buy opportunities. Now, if 20 crosses below the 50, we're going to focus on sell positions. All right, I feel like giving a little bit of a bonus here because EMAs are essentially lagging. And I like to use them to piggy bank on the markets. But what I'm going to do here is to show you what's actually happening behind the EMAs. I want you guys to remember this pattern. Higher high, higher low, higher high, lower low, lower high. This is a reversal structure. And I'll be talking more about this in another video. But if we're going down, lower low, lower high, lower low, higher, higher low. You will see these patterns behind the crossover of the moving averages. As you can see here, lower low, lower high, higher low, higher high, higher low, and then the moving averages cross. So the moving averages are essentially a confirmation that a reversal has broken to the upside or the downside. Now that we know what the crossover means and what a reversal is, the reversal can tell us where the last trend was and what the current trend is. So essentially, it will let us know whether we should be a buyer or seller. So now we know if 20 is above the 50, we should be buying, or 20 is below the 50, we should be selling. We don't just enter on the crossover, we enter on the first retest off the moving average after the crossover. And this is what we call the first cycle retest, also known as the 20 bounce trading strategy within Smart Charts. So here's how it works. After a bullish crossover, the market makes a higher high, and when the market pulls back and touches the EMA, we look for buy positions. So as you can see here, the market has made a higher high, higher low, higher high. Now, if we're selling, as we see a crossover here, what we're looking for is when the market breaks structure, a lower low, a lower high, a lower low. And all we can see here are simple opportunities or where the market retests after a reversal has happened. A very simple, effective trading strategy. Okay, so let's start that again. Let's remove these. So every time there is a crossover, we essentially want to take the first higher high, higher low that touches the 20 EMA. Okay, the first EMA, the first touch on the EMA. Now, what you can do after that is every time it touches the 20 EMA, you can use this for buying or selling opportunities. So let's look for another opportunity here. So as you can see here, every time the market crossed, every time the market touched the 20 EMA, higher high, higher low, higher high, and every time it touched the 20 EMA. Now, there are different ways on how you can enter and exit, but I'm going to show you how the 20 bounce trading strategy does it here on Smart Charts. So as you can see here, a signal has occurred. I've already entered the trade. This is the first crossover. The market's made a lower low. Now it's made a lower high. It's bouncing off the 20. Now in this case, it's going to risk a little bit more than what it's going to make. But if you catch the first cycle in line with the higher time frames, you can definitely get a higher risk to reward. Now here's where it gets powerful. If you combine this simple 20 bounce method with a higher time frame direction like the weekly bias or trend structure, which I cover in other videos, then you are no longer just reacting, you're executing with purpose. Now that's the simple yet powerful moving average strategy. That's been the backbone of my trading for years, and I honestly didn't think something this straightforward could be so effective until I stopped overthinking it and just followed the signals. Remember, the best trading systems aren't necessarily the most complex. They're the ones you can actually follow consistently. Watch this video here if you want to know more about price action. See you soon.